I'm making this video after seeing a lot of stuff out there comparing NVIDIA to the dot-com era crash. I mean, take a look at this. Some people have overlaid the Cisco stock chart to the NVIDIA chart to draw the similarities. It seems that every time NVIDIA stock has a huge pullback, an article pops out predicting its crash. So, let's take a look at whether this is a fair comparison. First, we'll look at the PE ratios. It's the ratio between the stock price to the earnings of the company. Typically, a lower PE is better, meaning stock price is low compared to how much it's earning, making it a good buy. Cisco had a PE ratio of nearly 200 around its peak, and NVIDIA right now has a ratio of around 60. So right off the bat, NVIDIA's valuation seems a lot more fair compared to Cisco. Now, having a high PE ratio doesn't mean that it's in a bubble. Trading at a high PE means people are anticipating a lot of growth potential. But is that anticipation justified or just mere speculation? Cisco sells hardware and infrastructure for networks. Is the demand for that sustainable? It's always easy to say in hindsight, of course not. Customers didn't have to upgrade their infrastructure continuously, and they didn't really have a wide economic moat. When I say economic moat, I mean its ability to keep competitors out. Pair that with a declining profit margin even before the crash, and now it becomes clearer why things happened the way they did. We can't predict what will happen to NVIDIA, but at least we can see if any of these factors from Cisco's story applies. So unlike Cisco, NVIDIA's customers would pretty much be forced to upgrade its chips to boost their AI capabilities if they want to stay competitive in their respective industries. As far as we can tell, the demand for chips is going up, and it looks sustainable due to the constant evolution of chip sizes and speeds. Now we look at whether it has a wide enough economic moat. The other players in the space, AMD and Intel, are playing catch-up, fighting for customers who don't need the top-of-the-line NVIDIA chips, who are looking for a cheaper alternative. You ever played a game where the person in first place is so far ahead that the remaining players are fighting for second place? That's where NVIDIA is at right now. So, the product is there, the market is there, the demand is there. What's there to fear? Well, NVIDIA faces supply issues. Their chips are manufactured by TSM in Taiwan, and we're far away from manufacturing chips independently in the US. Things look stable now, but the situation with China is getting a little bit shaky. Does NVIDIA have an answer if things go south with TSM? For now, NVIDIA's valuation is justified. Big names like Amazon and Microsoft are adopting AI tech, and others will have to sooner or later. If NVIDIA experiences a crash in the near future, it would probably be due to factors outside of their control, say, World War III breaking out. But I would hardly call that comparable to Cisco's downfall. At these prices, NVIDIA still isn't a terrible buy despite being near all-time highs. But I would be personally waiting for the expectations to cool off a little bit more. It wouldn't surprise me that NVIDIA meets the high bar that they've set, but I'm hoping for a more attractive price point before adding to my position.